Good morning, venture capital. This is Metagame, and today's episode is about how the Big Apple's magnetic pull is reshaping the entire investment landscape, as New York's fourth quarter deal-making creates a gravitational force that's warping the very fabric of capital distribution across the nation. $562 billion! That's what New York deployed last quarter, 26% of all U.S. venture capital flowing through a single state. Sounds like dominance, right? Sounds like the game is over and everyone else is playing for second place. Except here's what nobody's talking about. While New York was stacking that $500 billion, its deal velocity dropped nearly 8%. Fewer new opportunities, fewer shots on goal. Meanwhile, Massachusetts just posted a 17% surge in deal count. Connecticut jumped 15%. California added 11% more transactions. So the question isn't who has the most money. The question is, are you chasing where capital already sits or where momentum is actually building? Because those are two very different strategies, and only one of them is going to matter in 18 months. Let me paint you the picture of what's actually happening in New York. That $562 billion number is real. It's impressive. It's also misleading. When you crack open the top deals, you're not looking at the next Databricks or the next Stripe. You're looking at the Prime Liquidity Fund at $104 billion, Silchester International at $29 billion, Renaissance Institutional Equities at $28 billion. That's $161 billion right there in 3 deals. And none of them are backing founders building the future. They're asset management vehicles, institutional capital staging areas, Wall Street doing what Wall Street does, moving money around in increasingly creative structures. Now, don't get me wrong. New York absolutely captured real operating company raises. Kalshi pulled in over $800 million across multiple filings. Ramp crossed $1 billion cumulative, but the median New York deal isn't a software startup anymore. It's a financial services vehicle, which means when you say New York dominates venture capital, what you're really saying is New York dominates the infrastructure that finances venture capital. That's a different game entirely. California, meanwhile, is playing the game you think everyone's playing. 636 deals, $173 billion deployed, and the names actually sound like companies building things. Databricks raised $4.1 billion in Q4 alone, plus another $955 million and $666 million in Q3. That's a company in pre-IPO mode, not a liquidity fund shuffling allocations. xAI Holdings, Elon's LLM play, pulled $5.3 billion. Synopsys grabbed $2 billion. Genesis Cloud did 2 separate $1.5 billion raises. But here's what the California story misses. Deal count growth. Yes, California added 11% more deals, quarter over quarter. Respectable. But Massachusetts added 17%. Connecticut added 15%. The velocity of new opportunities is accelerating faster in the Northeast than on the West Coast. And in a game where early access determines ownership and ownership determines returns, velocity matters more than scale. Let's talk about Connecticut for a second, because this is the most underestimated story in the entire dataset. Connecticut matched Massachusetts in deal count, 244 deals each. But Connecticut deployed $27.8 billion more in total capital. How? Fairfield County's asset management corridor, Bridgewater, Viking Global, all-weather portfolio. These are the names that move billions without making TechCrunch headlines. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. But the operational efficiency is what should make every VC pay attention. Connecticut Innovations, the state-backed investment arm, deployed $16.2 million last quarter, just $16 million. And they leveraged $253 million in follow-on capital from other investors. That's a 15.6 times multiplier. They're not just co-investing, they're market-making. They've turned the state's balance sheet into a quality signal that pulls in coastal capital. When Connecticut Innovations writes a check, it's become a pattern-matching shortcut for allocators who are increasingly selective in a tighter fundraising environment. And then there's Massachusetts. The 17% surge in deal count isn't an accident. It's orchestrated. The Massachusetts AI Coalition, which includes Whoop, HubSpot, and DraftKings, is running over 100 in-person events this year. 100 convenings that turn into introductions, that turn into pilot programs, that turn into term sheets. The state's AI hub is funding something called the Robotics Digital Twin Initiative, which sounds like government jargon until you realize what it actually does. It creates shared simulation infrastructure that any robotics startup can use to run customer pilots faster and cheaper. Think about that for a second. If 67% of enterprises say their AI budgets are recession-proof, which is what KPMG found, then the region that makes it easiest to pilot and prove ROI is going to capture disproportionate mid-market deployment dollars. Massachusetts isn't trying to win the $5 billion mega round. They're trying to win the time-to-enterprise contract race, and right now they're building the infrastructure to do exactly that. So where does this leave the $202 billion in global AI deployment? California captured the pure-play AI infrastructure rounds, xAI at $5.3 billion, Databricks at nearly $6 billion cumulative across 2 quarters. That's real. That's defensible. That's where the foundation models and the compute layers are being built. But New York's strength in AI isn't building AI, it's financing AI. The pooled investment funds and hedge fund vehicles aren't backing seed-stage LLM startups. They're providing liquidity and portfolio diversification for institutions that are separately allocating to AI through West Coast general partners. New York is the back office of the AI revolution. Essential? Absolutely. Exciting? That depends on what game you're playing. Massachusetts is playing a third game entirely: shared infrastructure that de-risks enterprise adoption. The Digital Twin Initiative isn't funding individual companies. It's building a public good, simulation libraries, hardware testing frameworks. Any Massachusetts robotics startup can use it to run customer pilots faster and cheaper than their California competitors who are building everything in-house.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
Here's what this means if you're actually deploying capital. If you're New York focused, your market share is structurally defensible. Wall Street isn't going anywhere. Asset management scale isn't relocating to Austin, but your deal velocity is slowing while competitors accelerate. Are you losing early-stage deal flow to Boston and San Francisco? Will that matter in 3 to 5 years when those companies are raising growth rounds at prices you don't like? If you're California-focused, you're winning the mega round war, but your deal count growth is being outpaced by the Northeast. The seed and Series A market is heating up where you're not looking. The application layer, vertical AI for healthcare and logistics and manufacturing, is increasingly being built where the customers are. And those customers are often in Boston for biotech and robotics, or the New York corridor for finance and insurance and supply chain. If you're Massachusetts or Connecticut focused, you're winning the velocity game, but you're still capital constrained relative to the coasts. The question is whether you can convert ecosystem momentum into exits fast enough to prove the model works. If you can show that time to enterprise contract is genuinely faster in Boston because of pilot infrastructure, or that capital efficiency is genuinely higher in Connecticut because of state leverage, you can start pulling LP dollars away from the coasts. But if you don't monetize that advantage via exits in the next 18 to 24 months, allocators will assume it's just regional boosterism. So let me bring this back to where we started. New York deployed $562 billion, 26% of all U.S. capital, and their deal velocity dropped 8% while everyone else accelerated. That's not dominance. That's maturation. That's an ecosystem optimizing for scale while others optimize for speed. And in a market where the next wave of AI companies is being formed right now, where enterprise budgets are locked in and recession-proof, where the winners of the next cycle are currently raising their seed rounds, the question isn't who has the most capital. The question is who has the most momentum. New York has the infrastructure, California has the mega rounds, but Massachusetts has 100 convenings a year and shared infrastructure that makes pilots 3 times faster. Connecticut has a 15.6 times leverage ratio that turns $16 million into $253 million. Scale or velocity, infrastructure or innovation, where capital sits or where deals are accelerating. You can't optimize for both. So which game are you playing? That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.